What's up, everybody? Today's video is going to piggyback off of our 5 bucket investment strategy. So if you have not had a chance to watch that video, you should take a look before you move on to this. So we are going to dive a little bit deeper into the wealth management bucket, and we're going to cover what an actual investment is and why you should be investing. See you there.
Right, so this next video is supposed to tie into our 5 bucket strategy, but today we're going to be covering specifically the wealth management section. So we're going to call this Wealth Management 101. Now, typically when we talk about wealth management, I break it down into 2 different categories. We have our pre-retirement category, and then we have our post-retirement category. But I want to keep things really simple for today's video, so we need to start with the basics. So this is basically investment basics, and the reason why we invest, which is going to be compounding, and then what we invest in. So let's talk a little bit about compounding. Compounding is one of the most powerful investment concepts that you have working for you. Essentially, what compounding does is get your money working for you. So when we think about what makes up a good quality investment, we want to make it very, very simple. So I like to define an investment as something that you put money into that shoots out more money. Now, how do we get more money? And that's through compounding. So to give you a little bit of an example of how compounding works, we're going to run with an example where in year one, someone starts investing with $100 per month. No, excuse me, $100 per year. Now, throughout the year, they're going to earn 10% in returns, which is going to leave them with $110 at the end of year one. Moving into year two, they didn't take any of that money out. They still have $110 invested working for them, and we're going to keep the same annual rate of return to keep the numbers easy. So again, they earn a 10% rate of return on now $110. So that's an additional $10 that they didn't have working for them before. So now this person has $121 in their account at the end of the year moving into year three. One last example, we take that 121, we earn a 10% rate of return on it, and that's going to yield $133.10. So typically what happens with compounding interest is that the longer you invest, the more it builds up and you start to see exponential returns. Now, once you understand the value of compounding, this is the why you should be investing, why you should get money working for you, then you want to understand what you have available to invest in. Typically when we look at what, it can be broken down into the 4 different asset classes, which are cash, stocks, bonds, and alternatives. So now we're going to look at investment 101. So we've defined an investment as something that you put money into that shoots out more money, right? And we now have identified the 4 major asset classes being cash, stocks, bonds, and alternatives. Now, cash, we all know about cash. Cash is like your savings account, your checking account. This is the liquid assets that you have available. Now, I want to cue in on liquidity. The role that cash plays in your investment account is giving you the ability to buy new assets when you feel the time is right. You need liquid assets to make purchases. So typically when you were talking about investments, you still hold a portion of your investments in cash so you can make these pivots as you see necessary. The next exciting one is stocks, and this is a category or asset class that a lot of people are excited about, but a lot of people are also very nervous about, and they're afraid to start investing in the stock market because typically people are afraid that they're going to lose money. Now, when it comes to stock investing, what you're doing is buying a piece of the pie. You're getting ownership over a company. I want to cue in on ownership. When you have a piece of ownership of a company, you're able to partake in the gains and losses. So if that company goes up in value, you make money. If that company goes down in value, you make less money or you lose money, and you continue to ride wave of volatility. Next category is bonds. Bonds are often overlooked because they're not quite as exciting as stocks are. But the simplest way to think of bonds is an IOU. Bonds are considered debt instruments, and they allow you to generate interest by lending your money to another corporation or another entity. Just as if you were going to go to the bank and borrow money, the bank would charge you interest. In this situation, you become the lender. So when you lend your money to another entity, you're able to charge them interest. And last but not least is the alternative investments. Now, this can span a wide range of investments. I think the most common one we look at here is real estate. But it can also be like baseball trading cards or Pokemon cards. Typically, alternatives are considered the most aggressive type of investment when you're looking at the 4 different asset classes. If you want to compare, let's say, real estate as an example, the issue that you run into real estate is twofold. The first main issue is that it's not liquid, right? We're not able to turn a home that we own into cash very quickly. You need to put it on market, you need to sell it. There's a lot of steps that it takes to turn that property into cash. So it's not very liquid, it's illiquid. The other portion of alternatives are its comps. So if you're looking at a home and there's 2 properties that are very, very similar, they're placed on the same street, let's say they're right next to each other, it's very easy for one of those properties to be selling for much more than the other because maybe one has a bunch of luxury items in there, it has the granite countertops and the nice carpets, while the other one is a little bit more bare bones. Although these houses could be exactly the same on the outside, they could have the same amount of square footage, they could be sold for drastically different prices, so this creates a big discrepancy in what you are able to get for this type of investment, even though at face value it looks quite similar. Now, because we live in a day and age where it's not so simple as investing in stocks, bonds, cash, and alternatives, they have created many different types of investments out there that will actually include both stocks, bonds, and alternatives. So the 3 that I want to focus on in today's video is mutual funds, index funds, and ETFs. Now, the way I like to think of these are as an office building now, because mutual funds, index funds, and ETFs are considered pooled investments, meaning investors from all walks of life will pool their money together to buy shares of a specific investment that is comprised of many different underlying investments. So in this example, we're going to think of this office building right here as a mutual fund. So within this office building, there are a lot of different individual offices. Each one of these individual offices will represent a specific investment. So that would be a stock, a bond, it could be cash, and alternatives. So for example, let's say in this specific mutual fund, they own Nike. Nike is one piece of the entire picture. They also own, let's say, Apple and maybe Taco Bell and a bond. The idea here is that by buying into a pooled investment strategy, you are giving yourself immediate diversification. This specific investment can hold tens to hundreds of different companies, which is going to help decrease the volatility of your investments overall and let you slowly and strategically grow your wealth for the long haul. Now, when we speak about mutual funds in particular, there's going to be a drastic difference between mutual funds and ETFs and index funds, and this is communicated between the way they're managed. Now, mutual funds are actively managed, while index funds and ETFs are passively managed. Now, the areas that I want you to focus on when it comes to evaluating these different types of investments are the fees that you pay, the performance of the individual investments, and the service that you receive when you put your money in those accounts. So when it comes to active management, that's mutual funds in particular, what you get when you have active management is a team of people helping you. So there's a lot more service involved. There's analysts and there's portfolio managers and financial advisors that can help you as an investor make a decision on what mutual fund to purchase, and then once you do purchase that mutual fund, how it's actually managed on a day-to-day basis. Now, because you're paying for human help, the fees are going to be much higher than it would if you were going to be investing in a passive investment account like your index funds or ETFs. Now, when we take a look at how the investment, specifically the mutual fund, performs, there's a wide range of mutual funds out there and they have a wide range of performance. But generally speaking, about 80% of mutual funds underperform their benchmark, while 20% overperform their benchmark. Now, you might be asking yourself, what is a benchmark? Now, just like in the real world, the benchmark is a tool that we use to measure a specific investment. Think about it. I am a 180-pound male. If I was going to enter let's say, a martial art competition, would it be fair for me to fight a 100-pound female? Or would it be fair for me to fight a 500-pound sumo wrestler? Or would it be more fair for me to fight a 180-pound male who's my size, similar stature, and similar build? I think the answer is obvious. You want to compare apples to apples. So developing a benchmark is a way to make sure that your specific investment is doing relatively well. Now, when you're looking at mutual funds, you have high fees, you have the potential to outperform the investment, but you also have the potential to underperform the investment. And regardless of whether you underperform or you overperform, you're still going to pay a fee to the people who are helping you make these investment decisions. Now, contrary to that, you're going to have passive investments. Passive investments typically are things like index funds or ETFs. Now, because passive investments do not have people looking after them, it's actually just a computer screen with an algorithm that's making investment decisions for you. It's going to be a lot more affordable, or it's going to be a lot lower in overall fees. Now, when you're investing in a passive fund, most of the time your goal is not to overperform the benchmark. Your goal is to actually just track the benchmark. So the performance should be equal to the relative benchmark that fund is tracking. So it's very critical to understand the different types of investments and the different vehicles that investments have to move you towards your goals. Specific investments are stocks, bonds, cash, and alternatives, and then vehicles for investments would be mutual funds, index funds, ETFs, and then how those different investment vehicles are treated are going to have a major play in your overall financial health and the way you plan to create wealth for the rest of your life. So guys, I hope you enjoyed this quick breakdown on the wealth management bucket. Please let me know if you're interested in hearing more about mutual funds or index funds or ETFs specifically. We can also go into stocks and bonds and alternative investments. We can go a lot more granular on each one of these subjects, but I want to start at a level where you have a solid foundation before you get into the nitty-gritty details. See you guys in the next video.